Hi everyone. So the project idea that my group members and I have chosen is the stock market analysis, and here is a list of our group members. So we'll start with the project introduction. So we'll be conducting technical analysis to stocks and monitor its short-term and long-term fluctuations and make decisions based on this. We will then compare the log return for trading passively and trading actively, which is just the return for holding the stock and doing nothing, and the return for frequently trading using our strategy. So if the log of a return is better than the passive return, we will consider the strategy as feasible. The strategy that we'll be using is the simple moving average strategy, which is a popular technical analysis in stock markets, and we have chosen the 5-day moving average as the short-term MA and 60-day as the long-term MA, as they are commonly used in the real-life stock market. Simple moving average is calculated by adding up the past data points and then dividing them by the total number of data points, and crossovers of moving averages would indicate trading signals. Hence, if the 5-day moving average is higher than the 60-day moving average, it is a bullish sign and we will establish a long position by buying all stocks. Vice versa, if the 5-day moving average is lower than the 60-day moving average, it is a bearish sign and we will establish a short position by selling all stock. The next part is our basic programming, which contains the packages that we used, how we collect data description, and performance estimates. So first, you have to import all the relevant packages. We have used the request BS4 packages to crawl the required data. The NumPy and Panda packages are used for data sorting and data cleaning, and Matplotlib will be used for data visualization. So for this analysis, we have selected 30 companies within the 10-year timeframe, starting from 1st of June 2011 to 1st of June 2021, and data is crawled from Yahoo Finance. Here we have checked the data and saved it as the CSV file. However, based on Yahoo's anti-scrapping, we can only scroll a little part of the data. So therefore, in the following analysis, we use the CSV file that we have downloaded from Yahoo Finance. And the Apple company here will be used at our code demonstration. So start with reading CSV file that we have downloaded, and we will check the data by the head function. Here we could find the opening price, highest price, lowest price, closing and adjusted closing price, and the volume in the following table. By the prices described, we have made a summary statistics on the closing price of Apple. You can check the mean, standard deviation, minimum and maximums here. And the closing price is selected as a reference because it is the most representative of all variables. We then visualize the data by plotting the adjusted closing price. In general, the adjusted closing price showed an upward trend in this 10-year time frame. And we call companies that have this kind of data effective companies. To continue, the percentage change function is used to calculate the degree of increase. So we take every day as the unit and the second day as a reference to calculate the rise of stock market in the 10 years. Frequent increases occur, so the market in which the stock exists is an efficient market, which is more convenient for us to implement our strategy and make a comparison with the mean of short-term and long-term with different increases. Then we use the hist function to generate a histogram of the distribution of returns. The y-axis is the frequency, and the x-axis is the yield of return. Next is the trading strategies, which covers defining the mean average price of short and long-term moving averages, and then decide what position to hold based on this. So first, we will define short-term and long-term to 5 and 60 respectively. After that, we'll apply the rolling function of pandas to create a mean average price in the rolling dimension. Then let's plot a comparison graph. APL here stands for the Apple company's price, and SMAS stands for Simple Moving Average Short Term. SMAL stands for Long Term Simple Moving Average. Here is the graph. Well, it turns out that the S line is quite similar to the A line. While the L line is much smoother than the others, it is reasonable because short-term volatility is usually greater than the long-term. And don't forget to drop the missing values. As for the short-term moving average, you will only have the available data on the 5th day, and for the long-term, you will only have the available data on the 59th day. And to set the position during the whole investment period, we'll use the NumPy where function, which can label every transaction day 1 where data for the short-term moving average is greater than the data for the long-term moving average, and else 0. Because our strategy indicates that we won't hold the stock until the short term is greater than the long-term moving average. And as you can see here, the column position is added to the data frame. Then, adding a right y-axis named position will show us how many transactions we have made in this time frame. Using the secondary y function, getLegend setBox to anchor function can place the legend we want. And as you could see from the graph, many transactions has been made, and the strategy forces us to change position quite often. Therefore, to be more specific, we have created a loop to check the total number of transactions that has been done, which is 60 transactions, and it is actually quite a lot. So since we have got our positions, it is now the time to figure out whether our strategy is actually working or not, and we will check this by comparing the logarithm rate of return. So for the passive investment return, let yesterday's return be the numerator and today's return be the denominator by using the NumPy log and shift. And for the strategy return, it will be the interaction of position and return by simply multiplying position and return, which means that when position is at 1, strategy return is the passive investment return, and when position is at 0, the strategy return doesn't change. And once again, we need to drop the missing values. Then we can plot these two returns in a graph. The blue line stands for the return of using our strategy, and the orange line stands for the passive return, which is just holding the stock and doing nothing. And clearly, our strategy yields a higher return. However, keep in mind that it is the logarithm rate of return, so we have to write another code to get the real return. So the real return for the strategy is 14.56, and for the passive, it is 10.79. And our strategy has achieved a 35% excess return. Next is the conclusion. In the previous part, we could see that before 2013, Apple's investment for using passive is actually better than using our strategy. But after that, from 2013 to 2021, the strategy return is much better than the passive return. And to verify whether this strategy is actually feasible or not, we have applied this model to another 30 stocks within the same time frame. Here are the comparison of their return. And out of these companies, half of them yield a higher return by using our trading strategy, indicating that our model is applicable to some firm, but there are still limitations. And on the corner here is a scatter plot to summarize. Hence, for further improvements, we have thought about the following parts. In this case, we use the 5-day moving average to compare with the 60-day moving average, but there's definitely more combinations, and the selection of days will affect our analysis. And although we have collected data from different industries, for example, Apple, Walmart, Domino's Pizza, and Netflix, but these are all very material companies and they have been listed for at least 10 years. Therefore, our model may not perform well on small to medium-sized firms or newly listed firms. Next is transactions require transaction fees, but we ignore them in our model. Therefore, the actual return would be lower than the predicted return. And finally, moving average method is analyzing based on historical data, which cannot really predict future and may result in a certain amount of error. Well, this is all we've got for our presentation. Thank you so much for listening, and please feel free to comment if you have any questions.